going to go ahead and get started. I think we waited long enough. If they come in late, they come in late, and we'll just accept them if they do, I guess. So, anyway, I'm Mike Nash. I think I've had a chance to shake everybody's hand and meet you when it came in. It's a small group tonight, so it'll be a little bit more intimate. That's good. We'll have a chance to maybe interact, and you can ask some questions and things like that. But Sue is my wife, so we'll kind of be co-hosting. Be really nice to Sue if you would, please, because that really helps me tonight when we get home, and if she's in a good mood, that helps me, so be nice to Sue, would you? But no, I do thank you for being here. We're going to go till about 8 o'clock tonight. That includes the dinner, of course, so I'll speak till about 7:15, and then dinner will come in, and I assume you'll probably be out of here somewhere around 8 o'clock, so we will catch a little bit of the Cubbies game if you want to when you get home. Say just a couple, three housekeeping things real quick. Number one, if you got a phone with you, would you please do this, turn that thing off or put it on mute or whatever the case is. We, several months ago, we said your phone goes off while I'm talking, you buy dinner instead of me. We've had no problems with that whatsoever since we made that rule, so that's good. If you could keep the talking to a minimum, it's not a big deal with a group this small, I realize, but most of the time it's questions that you have and questions I'll probably get to at the end of the presentation, so I try to answer some general questions at the end, and then I come around to the table while you're eating and pester you a little bit and see if there's any questions you might have that I didn't address, and we can take care of that at that time. But Sue gave you, when you walked in, the folders. There's a response sheet in there. Would you please make sure you fill out the top third of that? We really appreciate that. I do need that for tax purposes. I do get a write-off if I buy you dinner. I don't know if you like that or not. I guess I don't care, I'm going to take it anyway, but we do need those in the file. If we get audited, they want to know for sure that you actually did attend the seminar, so if you please do that. A couple things about that response sheet, if you would, is that on the back side of this, we have people occasionally say, you know, we've got some neighbors or friends or relatives that I think would be interested in hearing some of the things you talked about. There's a place on the back side of that response sheet you can put their names. And we will invite them to come back next time to our next seminar. We try to get back to South Sioux every 90 days. And if you want to, if you're a client or not, doesn't make any difference. If you want to bring them back, we'd love to have you come back and bring your friends with you. So there's that issue. The other one is you'll see on the left side of the response sheet, there's a yes box. If there's something tonight that resonates with you, something that I say, that you say, you know, I'd like to know more about that, maybe it fits my situation, we ought to discuss it, you check yes there, and then when we get done, when you're eating, Sue will come around and she'll pick those response sheets up, and we can set up a time that we can get together on a one-on-one situation. So, who's been to a financial seminar before? Okay, all right, so about half of you. Okay, so I always tell everybody, we run these things like a timeshare presentation. You been to one of those? No? You're lucky. I tell you, Scott, you're lucky. I've been to a few. But they basically stick you in a corner and you buy something before you leave, and that's not what we do here tonight. Look, we're a little bit different, I think. We're very casual. There's no pressure here tonight. There's no PowerPoint presentation, as you can see. I'm going to work with some charts tonight and things like that. But we keep things pretty simple. I like it that way. And the only thing I promise is I'll make you a millionaire by Christmas if you do what I tell you to do. There's nobody here from the insurance department, right? Good, okay. No, seriously, the thing is that I think I do run a little bit of a risk when we go about doing this and simply being very direct with you and telling you exactly what it is I do. That's the way I'm probably more different than most other advisors. And when I say that, what I'm really saying is that you're going to know exactly what I do, how I do it, why I do it when you leave here tonight. Now, ideally, that would fit your situation. You like what I have to say. If you agree with that, that's great. We'll probably get together and talk. If you don't, it might be a long couple hours for you. So if you don't like it, just sit there and smile and pretend like you're having a good time. You're still going to get a free dinner at the end. We'll still have a good time tonight, or I'm going to have a good time anyway. So that's kind of where we're coming from. There's three principles that I really believe in. And I would like to think that those sort of align with your thinking as we get older and either in retirement, some of you are, some of you aren't, but these are three principles as I sit down with people and do planning with them. I'm really concerned about safety of your money, especially in these volatile times. I'm concerned about you getting a reasonable rate of return on your money. I'm not talking about 0.5% or 1%, but over time, a reasonable rate of return, and keeping things simple like I just said a couple minutes ago. Now, if those are three criteria that you can believe in when it comes to your money and you're doing retirement planning, then we probably have a lot to talk about and we can get together. If not, you know, I just tell people, look, I'm not right for everybody. I hope I'm right for you. I really do. We find about 70% of the people that come want to sit down and talk. But we realize there's a few that don't believe in what we're talking about here, and that's okay. I totally understand. So look, the goal tonight is simply this. I want you to have a good time. You're going to have a good meal regardless. Maybe you'll make a new friend. And you might learn a couple things that you can take with you that will even help you make wiser financial decisions for retirement. So that's kind of where we're at. Now, I just want to share a few things with you real quick about me, because when I'm sitting in your chair, I know oftentimes I'm thinking, who is this person and where are they coming from and those sorts of things. I'll just tell you, I'm not originally from Sioux City. I'm from eastern Iowa. I'm a Hawkeye fan. I was born and raised down there and grew up on a farm just 5 miles east of Iowa City. Ray, don't hold that against me, okay?
I was going to say, I was like, oh, great.
But I'm true blue all the way. So I'm a Hawkeye fan, but I was raised down there on a farm with 4 siblings, and I got 3 brothers that are all within 2 years, 11 months of my age. Got twin brothers in there. So you can imagine the havoc that we could cause back when we were young. But I really think the foundation of my belief system, of my values, were really formulated when I was very young. If you grew, who grew up on a farm here? Yeah, okay, so almost most of us did. So you understand what I'm talking about. When we talk about chores in the farm work, playing sports, I mean, there's a lot of structure in my life is what it amounts to. And I had great parents, and with playing sports and working hard on the farm and so on, I mean, they taught me honesty, they taught me work ethic, they taught me respect for other people, they taught me discipline. They really taught me discipline. Them and a junior high principal really taught me discipline. I thought the Board of Education, quite frankly, was the Board of Education. It wasn't. It's a board about this tall. I got familiar with it a couple times when I was in junior high. Had a principal who was an ex-Morrill drill sergeant, and he knew how to use the paddle, and I earned the right to get familiar with it a couple times. So I do understand discipline quite a bit. And but the thing is, I went on from sports in high school and so on to play college football along with my 3 brothers at the same time, which is kind of ironic. But the thing is that right after college I got drafted, number one, which is pretty cool. Except it wasn't the NFL. It was the Army. So I know I was talking to Scott over here. Scott, thank you for your service. I don't know who else served. Because I really have respect for veterans. What's going on? Thank you very much, guys. Appreciate what you did. But so the thing is that went to basic AIT, came home, I got married, went to Vietnam for a year, infantry, came back. It was the middle of the school year. I couldn't teach and coach like I wanted to, so I went back to school at UNK in Kearney, Nebraska. Once I got out of there, got back to Iowa, so I could make an extra $200 a year, because that was the difference then between Nebraska and Iowa at the time. I could make an extra $200. I thought that's a big deal. Back in the 70s, that was a big deal. So anyway, I got one interview to teach and coach, and I got the job. I was pretty excited about that. It's a small school down here in Schleswig, Iowa. And anyway, taught and coached for 3 years. By then, my wife is pregnant with our 3rd daughter, and the thing is that she wants to stay home with the girls. That's fine. So she gave up her job. Well, back when I was 26 years old, I wasn't very smart, and I didn't plan very long term. I can just tell you about it. So she gave up her job, so I thought, well, I can't raise a family on $7,200 a year. So I thought there's got to be something better out there. So I went out looking for a job, basically. Came home one day, told her I had a job, and all that. So that's all great. But I want to tell you, I wound up in sales doing this 39 years ago. It's probably the best decision I ever made. But the thing was, and here's what I want to get to, is that the first few months, that first time I came home, I told my wife I was in sales. She said, number one, you never sold anything in your life. You don't know what you're doing. I said, I know. She said, you better learn fast. And I did. I sold her a second car, everything in the basement, an old couch we had. So I sold a lot of stuff. But the thing is, quite frankly, is I went through a lot of anxious moments. A lot of anxiety, a lot of fear and frustration, a lot of tension at home. That's probably why we didn't have any more kids. But the thing is that I went through a period of my life I'd never want to go through again, because I had no idea where the income was coming from. I had no protection for the family, no insurance, no anything. For 6 months, we went through that period. And here's the thing. In the last 39 years, I can't tell you how many people have been in my office, and they're 65, 70 years old, and they're dealing with a situation where income is dwindling because their savings is going away because they're not making any money in their CDs at the bank. They can't afford to be in the stock market, so they don't know what they're going to do. They've got fixed expenses coming in every month, and they're sitting there simply saying, in 2 or 3 years, I'm out of money and I don't know what to do. Look, I only had to live with that for about 6 months. These people are living with that for 2, 3, 5, and 10 years. And it's not just the income, I think it affects the quality of life. So if nothing else comes out of this tonight, if we can just at each seminar, there's one person that understands that message and simply says, I need to plan, I need to do something better as far as protecting the money I have and making sure it's going to last for my lifetime. Because tonight I'm talking about safe money. I'm talking about your forever money, so to speak. So that's where I'm coming from. Look, I don't pretend to sit here tonight and tell you I can make anybody rich. But if we can keep a couple of people comfortable in their lifestyle they're accustomed to, so they're never really poor, then I think we've accomplished a lot. I'm talking about safe money tonight. That's where I'm really coming from. So, having said that, Susan, would you please do me a favor? Would you hand out the workbooks? And while Sue's doing it, while Sue's doing that, just a couple of 3 things. And Ray and Linda have good clients, Ray and Linda right here. And so if you don't believe anything I say tonight, you can check with Ray and Linda. Hopefully they'd say nice things about me. But I do appreciate them being here. We have clients come back from time to time, and that's wonderful. We always appreciate having clients here. But so they've heard some of these things before, I know. But the thing is, while Sue's doing that, just a couple things to kind of set the tone for the seminar is, number one, there's a survey about 10 years ago. And the demographic was, they sent this survey out to, I think it was 500 people across the country. It was people pre-retiree and in the retirement phase of their lives, 55 on up. There's 50 questions. The one question I always remember is, it said, look, how much of your retirement nest egg can you afford to lose? And they had options. There was 5 potential answers: 0 to 10%, 10 to 20, 20 to 30, and so on. What percent of the people do you think said 0 to 10% is the most I can afford to lose out of my retirement nest egg? Any ideas?
I mean, the whole works.
There's 72%. It was close to 90% by the time you figured in 10 to 20%. In other words, as we get older, I think most people believe that they ought to be more concerned about safety than chasing returns in the market and things like that. One of the things that really astounded me is I just read recently, it said there's a certain percent of people are more concerned, more afraid about living their income than dying. You know what that percentage was? This blew me away. 61% of the people. Now imagine this. This is where we are in our thinking in this country as far as retirement goes. 61% of the people more afraid about living their income than dying. But you know what the number one fear is of people almost across the board without exception? Doing what I'm doing right now. Public speaking. So, Linda, be nice to me. Okay, tonight? You be nice? Okay, good. All right. So, no, listen, I do appreciate you being here. Listen, let's get right into it. And if you'll just open those, understanding your money. Let's talk about some of those things real quick. This is important stuff. But let me ask you this. What's going on in the world today? When we talk about understanding your money, I think it's more important now to understand what's going on with your money than it ever has been. What about debt in this country? Think about the debt. What's happened in the last, especially the last 8 to 10 years? Where are we as a country? You know how many $1 trillion in debt we have? Just the budget debt. I'm not talking about Social Security, Medicare, and Medicaid. $20 trillion, right? That is amazing to me. If we ran our households the way the Washington, D.C. is running the country, we would have filed bankruptcy years ago. Unemployment rate is not what they really tell us it is. The markets are very volatile. I mean, it used to be 30 and 40 years ago, if the market moved 400 points in 1 year, that was a big deal. Now it can move 400 points in 1 day, and it's just a ho-hum day, isn't it? So the volatility is unbelievable. Here's the thing I'd like to do tonight. I think we're in a world of uncertainty. What I'd like to do through this information tonight is create some certainty in your lives on what's going on, if that's okay. So the next thing, low interest rates. I don't need to talk to you folks about this. You know where interest rates are at. You go to the bank and put money. If you did that, Larry, in a CD at the bank, what are you going to get? Nothing. Nothing. That's about right. 1% on a CD, maybe, let's just say, okay? But we know inflation year in and year out is an average of 3%. So in purchasing power, we're giving up 2% year after year after year, aren't we? So in 10, 15, 20 years, we're in trouble, especially the seniors who have it in the bank in money markets and CDs. Going. So let me ask you this. Why do they have money in the bank then? What's probably the reason why they have money in the bank?
They don't know where to put it.
Probably a really good answer. They don't know where to put it. What are the other options? But usually they'll say, well, it's protected there. It's insured. It's guaranteed, right? You got the FDIC. Well, let me ask you this. If you could take those factors, the protection, the insurance, and so on, and if we could do an upgrade of from, say, 1% to 3, 4, 5%, would you be interested in hearing more about that? Because that's what we're really talking about here tonight. Most people feel you've got two options. Larry, you hit it on the head. You got the bank, and if you don't do the bank, you do the stock market. We're going to be talking about a third option tonight is what it really amounts to. So just hang in there with me in the next hour or so, and that's what we'll be discussing. The market. What can we say about the market? Holy smokes. Let me ask you this. Who gambles in here? Is the market a gamble? I think everybody would agree, wouldn't they? Okay, maybe I'm the only one. I'd look. I gamble very little. I play blackjack once in a while. If we're at the casino or whatever, my limit's about $100. I put $100 on the table. If it's gone in 5 minutes, I'm up and out of there. If that $100 turns into $400 or $500, Sue comes and takes the earnings and walks away with it, and I can still play my $100. That's how we operate. So you can tell who rules things at our house. But seriously, if that's who would take their earnings and walk away, or would you sit there and try to turn it into 2,000? No. So if you're like me, then we probably need to talk. You need to check yes, because that's where I'm really coming from. Is that's the concept and theory of what we're talking about here tonight. But if you're going to gamble, there's a couple of rules you ought to follow. And I try to follow these, not just with my money, but with your money as well, if I'm working with other people advising. And number one is, and this is something, I don't know if you remember, if you read anything by Warren Buffett or not, but Warren Buffett says that the number one rule of investing is what? Never lose money, period. That's his number one rule. Read his books, read his articles, that's what he says, you never lose money. But the first rule actually, that ties in with the rule that he calls the rule of 100. And that's really simple because if you're 60 years old, you take your age from 100, and the difference is the amount of money that you should have at risk. If you're 70, you should only have 30% at risk, right? Just kind of a rule. Now, is it a firm guideline? No, depends on some other circumstances and so on. But the other thing that I like to talk to people about is buying low and selling high, right? Those are two pretty good rules, I think, to follow. Rule of 100, buy low, sell high. So, let me ask you this. Does your broker tell you that? For those of you who have a broker, have an agent, have an advisor, do they tell you that? No, I can almost tell you for certain they don't. They don't tell you that. Did we have a high in the market last summer in 15, August of 15? The answer is yes, we did. Did we have another high this summer? Yes, we did. Did people sell? No, for the most part, they didn't. So who's following the rules? So why didn't they sell? We're going to talk about that tonight. So, if you just follow with me and then what the experts say. Well, first of all, I don't know who the experts are. But if you follow along in the workbook there and make any notes, the experts in your mind might be Susie Orman. I don't know if it's Dave Ramsey. I don't know if it's Jim Cramer. I don't know who your expert is. I really don't know, but I will tell you this. I keep going back to thinking this thing through 15, 16 years ago now, 2000. Do you remember the study they did, the experiment they did? They took a monkey and basically had him throw darts at a board that had all these different stocks on the board. They did this for 5 years, and he just threw darts and picked out stocks that way, and they had the experts sitting over here for 5 years. You know the rest of this story. Who do you think had the best returns at the end of the 5 years? The monkey. Okay, now, before you guys start asking me about the monkey, number one, he wasn't licensed, and number two, he died a couple years ago. So I don't want you to think you can go find the monkey, okay? But you know, isn't that amazing that you got all these experts out there, but yet at the same time, everybody's got a different opinion. And I'm going to tell you tonight, we're talking some facts and we're talking some opinion. I'll tell you when it's my opinion. And you probably know anyway. But, so the experts, I'm not sure exactly who the experts are, but I will tell you that it's a different world today, it's a different market today, and you know that. But there's a couple of things. You can talk about what happened to as an example, What happened to IBM from 30, 40 years ago? Do you hear anything about IBM? It was in the news the other day. I haven't heard anything about IBM for 6 months. All of a sudden they're in the news. Who took their place? Facebook and Amazon and Apple and Google, right? All those companies. So the whole landscape has changed as far as that goes. Exports, imports, are we the export capital of the world anymore? What we do? Not at all. We have hundreds of billions of deficits in trading each year in this country, don't we? Totally changed. Manufacturing has gone away. It's a different world out there right now. But if we bring this thing back home and talk about how it affects you, what's the one thing that you can think about that your parents, grandparents, whatever, when they quit working 20, 30, 40 years ago, what did they have, Scott, at Blue Bunny or any place else that has definitely gone away at Blue Bunny and other places? I'm not picking on Blue Bunny. Scott happens to work there right now. But at the same time, you retire after 30, 40 years at one place, and nobody left their job. They basically were there for 30, 40 years, and they left. They normally got two things. What did they get? They got a gold watch and a what? Pension check, didn't they? Anybody here, not too many pensions anymore, are there? Linda's a teacher, there's a few other people who have done things that, but basically, pensions have been replaced by what? The 401k, haven't they? And some people say, no, it's the 201k. And so, money has been cut in half in a lot of cases in the last 10 years or so. But so, if we move on to, I'm just going down the bullets that you have there on that page, if you just follow along that page. But over time, the market outperforms everything. Well, we're going to take a look at this in the next few minutes. Safety through diversification. If you're making notes there, safety through diversification. Let me ask you this. Who lost money in 2002 or 2008? Who lost money? Okay. I mean, if you didn't raise your hand, I think you're just being bashful and shy, because almost everybody, if you had an IRA, if you had mutual funds, if you had a 401k fund, you lost money in the market because the market went down 40, 45% twice in the last 15 years, right? So here's the thing. When we start talking about that, diversification doesn't work. It just doesn't work. It's not that simple. Here's the thing. If you had a brokerage account, I can tell you your broker tells you you're diversified because you have stocks and mutual funds, you have bonds, and maybe you have a real estate investment trust or whatever. The point is, in 02 and 08, did it make any difference how you were diversified within the market? Everybody went down 40, 45% across the board. So my question is, what is diversification? Well, diversification is having some of your money in a safe place and some of it in the market. But how can your money be at risk in the market and still be safe? Safety through diversification doesn't work very well. I can tell you that. We'll take a look at that in more detail here in just a few minutes as well. Buy stocks and mutual funds. Well, if I was to ask you what is financial security, you probably get a lot of different answers. You could read volumes about financial security. But when it really comes down to it, I always tell people, look, financial security, if you want to keep it simple, it's making sure that you don't run out of money before you run out of breath. Period. That would be a pension type design, wouldn't it? But isn't that financial security? So can stocks and bonds and mutual funds, can they do that? The answer is no, they can't do that. They can't guarantee you income for life. There's no way. So we're going to look at what I think would be a better option for you tonight. I do want you to know, though, that I can do either. Look, I've got my stockbroker's license, so we do set up brokerage accounts. I'm talking to you about one phase of what we do in financial planning in regards to retirement. But tonight I'm talking to you about safe money. I'm not talking to you about setting up a brokerage account is what it amounts to. Paying fees is normal. On your next bullet, on your workbook there, paying fees is normal. I want you to scratch out normal, and I'd like you to put it optional in there. Optional. I don't charge fees. I do not charge fees. Everyone loses money sometimes. Ladies and gentlemen, anybody who did what we'll be talking about tonight, who did that with me 10, 15 years ago, did not lose a dime in 02, did not lose a dime in 08, period. And they've gotten reasonable rates of return along the way. So, listen, what's the one thing, when we talked about younger versus older investors, I think that's the next point on your workbook there. What's the one thing that younger investors have that older investors don't? Time. Exactly. How critical is time? I mean, that's the most precious commodity we have is time, isn't it? So if you believe like I do that as you get older, you got to be more concerned about safety than returns on money, then we probably have a lot to talk about. Then you might want to check yes, and we might want to try to get together and set up a time to visit about that. I'd love to do that with you. Now, here's what I'd like to do right now. I'd like to just have a little bit of fun with you for just a minute or two here. Let me ask you this. In fact, I'll show it to you. Ray with it? You've got to just hold off on this one, okay? Because you've seen this. But, all right. Everybody recognizes this, right?
I remember, I don't remember.
But, so what is this? Christy? Stop sign. Exactly. Okay. So what's the shape on this thing? What do you call an octagon? And the color is red. Exactly. So I hope you do stop, in fact, when you see this sign. Okay? If I did this, what kind of sign is that? I don't have the board for it. What is this? Railroad crossing, exactly, okay. Is it black and white, Larry?
No.
What color is it?
Yellow.
Is it? I think it's black and white. But anyway, so is it black and white? Okay. All right, let's move on to one other one. Let's do this then. If I did this, what kind of a shape is this? Triangle, exactly. Okay, and the triangle would represent what type of a traffic sign then? Anybody know? Yield, okay, exactly. And the yield sign is what color, Bob?
Yellow.
Yellow, exactly. Okay. You're sure? Okay. Are you sure, Ray?
No, it's red.
Linda?
Heard this the other day.
I'll see if I'm wrong.
Red.
You sure about that? Okay. So you weren't willing to bet dinner on that tonight, were you? Okay, but why do I even bring this up? I mean, and this might make you feel better, Bob, okay? Because the federal government just changed this not too long ago, from yellow to red. You know what year that was?
No, not for sure.
Not for sure? Joyce, what year was it? Anybody want to take a guess? Just take a guess. It's
Probably
okay.
60s.
Yeah, 1971. Okay? Ladies and gentlemen, here's the thing. Here's the reason I do this. Because our brain kind of tricks us, doesn't it? I mean, we're all old enough in this room for the most part. We can remember back in the 70s and 80s. The markets performed differently in the 70s and 80s, didn't they? Okay, we can talk about 6, 7, 8, 10% returns on money sometimes and get away with it, okay? We can't do that today. The thing is that we've been so conditioned, I think, to think that the markets today perform the same way as they did back in 1971. We've been so conditioned to think that the yield sign is still yellow like it was back in 1971, right? Look, my job tonight is not to sell you anything. I don't even consider myself a salesperson, okay? I really don't in a lot of ways. I like to give you choices. We talk about situations, issues, problems, challenges, whatever, provide you some choices and what you think might be the best answer for it. But the thing is that when we talk about the traffic signs right here, and we think about where we were 41 years ago and how things looked then and how they look today, we're still kind of stuck in the mud back in the 1970s is what it amounts to. So all I'm trying to do tonight is to get you to think differently than what you were when you walked in the door. It's about that simple. We're going to talk about the red yield sign of the financial world of 2016. You know, I think it was Mark Twain that said, you know, it ain't what you don't know. That's not how I normally talk, but you like to relate to it. It ain't what you don't know that gets you in trouble. It's what you think you know that ain't so that gets you in trouble. And isn't that the truth with these and what we're talking about right here? So anyway, here's what I'd like to do right now if I could. We're gonna get into this first board here real quick. I don't know if you folks over there, Scott, Joyce, I don't know if you can.
It's fine.
Um,
We can see it fine.
Can you see it okay?
Yeah.
Okay, good, that's great. So, anybody tell me what this board represents?
That's the market.
It's the market, exactly. And which index is this? S&P 500, right? So what I'd like to do tonight here for the next few minutes is take you back to 1998 right here. And I'm just going to loan each of you $100,000. I wish I could loan each of you $100,000. Okay, and you're going to invest $100,000 in the market back in 1998. Now, does anybody remember what was going on back in 1998 with the markets? What was the thing that drove the market? What were the events going on back in those days that drove that market straight up for the next couple of years to the year 2000? Does anybody remember? The dot-com, exactly. We took $100,000 right here, we invested in the market, and we just let it sit in the index, and the dot-com took that from $100,000 up to almost, was it $137,000? I forget. Yeah, $137,000 in 2 years. Now, how do you feel about this? Pretty darn good, right? I mean, 18% a year compounded, that's pretty darn good returns. So, we're sitting there and you go to the broker and you say, you know what? That's not a bad gain for 2 years, $36,000, $37,000. I think I'm just going to take my money and run. I'm going to cash in my chips, I'm going to go to the cage, I'm going to take my money, go home and call it a day. Now, what's the broker going to say?
Leave it in.
Leave it there. Exactly. Okay. So you say, you're going to be crazy. I mean, we can take this. This thing's got legs. It's running. We can go to 150 on this, maybe more. So you say, well, you know what? This gal or guy or whatever, they must know what they're talking about. They've been doing this for a while, so I'll just sit on this and just let it go. So we do. So what happens the next 2 years? What does the 137 do for us? It loses $58,000, 44% the wrong way. So now, after 2 years of anxiety, I'm going to live through 6 months of this, but so we're going through here a phase for a couple years, $58,000 is vanished away. So we get to this point and say, I can't handle this anymore. We're down to $78,000. You go back to the broker and you say, look, I've had it. This is it. I'm done. I can't handle the market. Just cannot handle the risk. So what does the broker tell you here? You're not going to get out now. You'd be nuts to get out now, right? I mean, why would you want to do that? It's going to do what? It's going to come back, isn't it? Okay. So, you know what? Fortunately, it does start to come back here. But here's the thing that just blows my mind sometimes, quite frankly, is that people in the market talking to the broker, it goes up to $137,000, it goes down to $78,000. We just lost almost $60,000. We go back to the broker, and what do? We ask for advice. The guy or gal just advised us on how we could diversify our brokerage account, whether it's mutual funds, stocks, bonds, whatever the case was. We lost almost $60,000, and we go back to the same person and say, okay, what should we do now? Now, isn't that a little bit like, I mean, there's no other area of your life that you would manage like that. You wouldn't. Now imagine this, we're all old enough to be grandparents in here. If you took 2 of your grandchildren to the daycare, let's just say, you drop them off in the morning because you're helping your kids, you drop them off in the morning, you go to work, you come back at 5 o'clock after work and pick up the 2 grandkids, and they say, you know what, I hate to tell you this, we lost one of your kids, one of your grandkids. Yeah, that's right. What? Now, this is a crazy example, maybe, but I'm trying to make a point here. But the thing is so you got to be kidding me. So yeah, we don't know. I mean, things happen. We took our eye off the ball, whatever. So you're going home with 1 kid, and let me ask you the question. So are you going to take the 1 remaining grandchild back to the same daycare? Are you going to pay them for the lousy job they've been doing? They just lost half of your precious assets, whether it be in the market here or your grandkids or whatever. Are you going to go back to the same people and now say, it's okay, take care of this one? Now, the other night, I said the same thing, and some lady said, well, it kind of depends which grandkid it was that they lost. I mean, so I think we can all relate to that. But the point is, so you get down here, and you got $78,000 now out of your 100. We're 4 years down the road. And so what do they call this? They say, look, it's just what kind of loss? A paper loss, right? A paper loss. So here's my question. If this is a paper loss right here, up here, is that just a paper gain? That $37,000 that we gained, is that not real money? I think that's not the case. They always tell me, and I've been on the other side of this before I got my stockbroker's license. But they used to tell me, look, you're in this for the what haul? The long haul. The long haul. Ladies and gentlemen, this is not a knock on me or you, but my question is this. How many more long hauls do we have? Think about that. And did you have any control over what happened here? This is what always drives me crazy. Did you have any control? I mean, if the terrorists decide to blow up buildings again, if some dignitary gets shot, if the feds decide they're going to bump up interest rates and affects the market or whatever, do you have any control over what's going on? None. You really don't, do you? So the point is this. You didn't sell here, you didn't sell here because they said, you'd be nuts to do that, right? When do you sell? Can I tell you? Never. Never. Why?
It always comes back.
In it for the long haul. But can I tell you the dirty, rotten little secret, the dirty little trick? When you put your $100,000 in the market, if I was your broker, I get 1%. I get 1% right there. I get 1% down here. If all my clients decide they're going to go away, they're going to cash out, they're going to walk away from the table, what did I give up? 1% every year for, in this case, 17 years. Right? That's the dirty little secret right there. So here's the nice thing is this. The market did come back, didn't it? So it's $78,000. So the $78,000 goes all the way up to $145,000. Now we're 10 years down the road now. $45,000. Now the broker's a hero, right? So I come back and say, hey, you know what, Bob? Look what I just did for you. I just made you $45,000. Now a couple things come to mind real quick with me. Is that number one, 10 years, that's 4.5%, would you say? Okay. Is it that? No. I need to tell you this. In this chart, I did not take out taxes or fees. I don't even want to get in, because I don't know what your tax bracket would be, so I didn't build anything in. The fees I didn't take out. If it was fees, it'd really be about $10,000 less. But let's don't even go there. Let's just say, this is gross here. So $145,000. My question is this to you, Bob, is that's $145,000. You made me $45,000. I was at $137,000 once before. Didn't you make me back old money? I mean, when you take a look at it, I could have cashed out there, and I'm only here now. So in 8 years, you took me from $137,000 to $145,000, right? So, can I ask you this? What is it about right now? Let's suppose that the market does what it did back here and here. If the market did that right now this year, or in 2017, and we had a 40%, 45% dip in the market, what is the difference to you folks in this room? You good folks that have worked so hard for your money for the last 30, 40, 50 years, what's the difference now is how, in regards to how that would affect you versus here or here? We just talked about this about 15, 20 minutes ago. It's called one thing, time. Time, exactly. So, I've had people in the office that timing wasn't very good, quite frankly. And when you get to a point where you're banking your retirement nest egg on the market, and the market fails you, the choices are pretty rotten. Because if you're working, you got to keep working. If you're retired, you got to feel like, can I go back and get that job back again? Chances are you can't. Or if you can get some sort of a job, it's going to pay less money, or you're going to adjust your lifestyle. Not very attractive choices, right? That's where we're at with this thing. So, there's one thing I read a couple, 3 months ago. I tried to read a lot of stuff about retirement planning and whatever, but this nailed it as far as I was concerned. And this is one of our trade journals. This is a, quote, expert. But the theme was this, and he wrapped it up with this. He said, if you're a baby boomer, and who in this room doesn't really qualify as a baby boomer? Most all of us. Okay, do not under any circumstances have a huge capital loss. Period, is what he says. You can't afford it. He said, this group is accustomed to seeing big market drops and big recoveries. They have no more time for that. Their investment strategy must now limit their losses and come to terms with the fact that they're likely to outlive their greatest expectations and therefore outlive their money if they're not careful. Ladies and gentlemen, that's scary stuff. But you know what? I'm not talking to you tonight about what you want to hear. That's not my purpose. I'm going to talk to you tonight about what you need to hear. And that's where I'm coming from. So, when I talk to you about the essentials, the safe money, the forever money, that sort of thing, that's what I'm really referring to here. Is I want to make sure that, because some of you know a whole lot more about construction than I'll ever know, but if you're building a house, when we talk about the essentials for retirement, what I'm interested in doing is trying to protect the dignity of your lifestyle in retirement. And it's right here. This is the safe money, right in this area right here. Now, if it's suitable for you to have more money to put into the, if you do have more money that you want to put into the market, maybe you get the returns, maybe you don't. These are your wants, dreams, desires. This is when you can go see the grandkids a couple times a year. You can travel to Europe if you want to. You can buy that second home if you want to as a vacation home. But I'm interested in this right here, making sure that's solid. That's built on protection, insurance, and guarantees and things like that. So, look, you can ride this roller coaster if you want to. And that was fine when we were 15 and 16 years old. Maybe all we lost then was our stomach, because I did a few times. But now, I'm concerned that you could lose your retirement nest egg, is what it amounts to. So, there's one thing I'd like for you to write down in your workbook tonight. I don't know where I put it here exactly, but there's some numbers I think are essential for you to think about. And it gets you to really thinking about where we are right now in real time with the markets and the economy today. And it's these numbers right here. And if you want to write them down, I think that'd be great. But what this really represents is this. 25 and 45 represent the bear market. And you know what those two numbers really represent? The bear market, the average bear market, the market's going backwards on us, is 25 months. You know what the average loss is during that 25-month period? 45%. That's the average loss. That's in a bear market. Now here's what brings us home, I think, is that we talk about the bull market. The 54 months is the average bull market in months. That's the average. 54 months. A little over 4.5 years, whatever it is. You know what the 92 months right there represents? That's how long we've been in a, quote, bull market since we came out of the Great Recession. Ladies and gentlemen, what do you think is going to happen? That's the average. That's where we are. That's the trend. That's the pattern. Look, I don't have a crystal ball. My opinion. I don't think your timing could be any better than to sit here and us talk about this. You know what's going to happen in, I guess it's not next month now, it's November, but in December, what are the Feds going to do?
Raise interest.
Probably raise interest rates. If not, it's coming shortly after that, isn't it? What happens when interest rates go up? Markets go down. No? Ladies and gentlemen, if you read half of the stuff I read about the markets and what's going on with the bubbles out there right now, you could talk about college debt. Just read an article the other day. Corporations right now, as far as their debt equity ratio, it's worse now than it was in 2008, before this thing really fell apart on us. We talk about the cash overseas that they want to bring back, the trillions of dollars. Ladies and gentlemen, corporations today are not cash rich, not based on this article. What they're saying is that they're on the edge right now with how they're handling their money. It's kind of scary. I don't want to paint a terrible picture for you, because I think there's some things that we can do to help resolve some of that, put you in a better position. But that's the market. Look, let's move on then. And what I'd like to do is, let's see, on your page 2, retirement plan rules. Most of you know these. The IRAs and the Roth IRAs. You can take a look at that. Some people ask me, well, how much can you put in? Most of us probably know you can put in $5,500 a year into your IRA or your Roth IRA, unless you're 50 or older, and then you can do $6,500 a year. So who can tell me what's the best way to take money out of your IRAs? As a lump sum, over time, what would you say? It's usually over time. In fact, with very few exceptions, it would be over time because of the tax situation, right? Because you haven't paid taxes on the IRA. The Roth is a little bit different situation. We can talk about that one-on-one if you have some questions. The next point, though, is in regards to 401ks. And this could just as well be like a 403B if you're a teacher, things like that. But the 401ks, it used to be 30, 40 years ago, everybody worked at the same position, the same job for years and years and years. That's not the case today. I think the average person has like 3 or 4 different jobs over their lifetime. So what I've found is that there's a lot of people out there who worked someplace 5 or 10 years ago. They had a 401k plan, but they didn't do anything with it when they left. The old employer still has the 401k plan. Whoever the third-party administrator is still overseeing that 401k money. Well, that's quite frankly ridiculous. You need to get that out of there. You need to get that into your own personal IRA for a lot of different reasons, many of which I can talk to you about one-on-one, but you need to take care of that issue. It's called just a tax-free transfer. I mean, we do them all the time. But that's if you got old 401k money. Now, if you're still working and you have a 401k and you're 59 and a half, then almost without exception, you can take money out of your 401k if you want to. Sometimes there's very few options on how to invest that money, and you can move that money into your own personal IRA. You have to check with HR and some of the finer rules with your particular 401k plan, but very few exceptions where you couldn't do that. So that's important to know as well. We talk about sort of an adoption agency for old 401k plans, but I'm going to move. I want to hit some points here that I think are important. But the 59 and a half rule, without getting into a lot of detail on that, I'll just say 59 and a half rule. Just make sure that you don't take money out of your qualified plans, your 401ks and IRAs before 59 and a half. You got a 10% penalty. Most of you are aware of that. Plus you pay the taxes. So you want to stay away from that if you can. If we move on to the 70 and a half rule, this is where it really gets a little ugly, quite frankly, is that at 70 and a half, most of you know, you have to start taking money out of your plans, your IRAs, your 401ks and things like that. So that being the case, if you don't, the penalty is what? It's 50%. If you're supposed to have taken out $2,000, then you're going to have a $1,000 penalty, plus of course the taxes that you're going to owe. I can tell you, quite frankly, there's a lady here, this is probably 8-10 years ago now, but she had $300,000 in her IRA. Widow lady, nice lady, $300,000. Nobody ever told her to take her RMDs, or required minimum distribution. Yet the money sat in there. She died at 87, 17 years later. She had 3 kids. The kids all thought they were going to get $100,000 apiece. By the time the government came in, chopped up that $300,000, the 50% penalty on money she should have taken out for 17 years, plus the taxes, plus the interest and fees and so on, the kids got about $9,900 apiece out of $300,000. So please make sure that you're paying attention to what's going on there. That is not a situation anybody wants to get into. You probably all know what the difference is between tax avoidance and tax evasion, don't you? Scott? 25 years? Yeah, about 25. You're right. Okay, well, moving on to page 3. Qualified retirement plan rules, or issues, excuse me. The problem is risk and fees. Risk and fees. And just examples we've talked about on number 1 there, stocks, bonds, and mutual funds. I will not spend more time on that because we just went through this, the red line, as I call it. So we pretty well talked about that. But the second thing is variable annuities. Variable annuities. A variable annuity is nothing more than a tax-deferred mutual fund with all kinds of fees and risks involved. I do not like variable annuities, period. My opinion. If you've got one, I think we ought to talk. Most people have no idea what they're paying in fees on those variable annuities. Most of them, as an average, are 3 to 4% a year. It's ridiculous. So I had a widow lady, this is not that many years ago, 4 or 5 years ago. Her husband died, left her $150,000. Somebody talked her into it was about 6 years ago now. Talked her into a variable annuity. She put the money into a variable annuity. She came to one of our seminars. And I didn't say nice things about variable annuities. Well, I said, if you've got one, we ought to talk. So on her response sheet, she simply said that, look, I need a couple of weeks, I want to talk to my agent about this variable annuity. I said, that's fine, you do that. She came in one day to the office and she kind of stuck her finger in my face and said, young man, I think you lied to us about these variable annuities. I called my agent, I'm paying $50 a year for the cost of my variable annuity, $50. And I'll just call her Mary. I said, Mary, if that's the case and you've got a good variable annuity, I'll buy one. And she said, okay. And I said, do me a favor, will you spend 20 minutes with me? And she said, I will. She came into the office, we went to the conference room, we got on the phone, we called the insurance company that she was with. Got this lady from, get this, India, from the service center in India. So this was fun. So anyway, got permission for me to talk to this lady from India when Mary was sitting here, because I wanted to ask her 3 or 4 specific questions. Number one, you don't care about the necessarily the different fee factors built into that variable annuity, but there's 4 of them. There's what they call M&E, administration, writers, and the advisory fees to manage the mutual funds. I asked specifically about each one of those 4. When we added those up, you know what the total cost was each year that she was paying on her $150,000? 4.1%. Take that times $150,000. So let's just call it $6,000 a year, right? $6,000 a year. I did the math right there in front of her while this lady with the service from the service center was right there, and I could see she was distraught, upset, whatever. Finally, we hung up, and I said, Mary, what do you think? She said, excuse me, but she said, I think I got screwed the last 6 years. Now think about this. $6,000 times, she spent $36,000. Do you know what her $150,000 was worth? $172,000. The insurance company got $36,000. She's got $22,000. Now who's winning in that deal? She said, well, she said, if I haven't insulted you to the point where you won't work with me, would you help me get out of this thing? Now, fortunately, we could get her a 5% bonus at the time. She had a 5% penalty yet under contract. So, in her mind, she just saved $6,000 a year, plus she got a bonus of 5% on her money. She was pretty happy. But, ladies and gentlemen, people every day got these variable annuities. They have no idea. They're not paying attention to what the fees are. It's just like your brokerage account. It's buried somewhere in page 14 or 15 or whatever, and nobody knows. Nobody's telling you. I'm telling you tonight. So, down at the bottom, what you need to know. Fees and charges can be very expensive. Fees and charges, and there's a risk of loss. Even if you're principal, risk of loss. So, you've got one, we ought to talk. So what's a possible solution? Well, so there is some good news in all this. We talked about all the issues, the problems, the challenges that we have, but I think there is some good news in this. So let me ask you this though. On your page 4, why do you have insurance on your life, your car, your home, health insurance? Why do you have that? Protection, isn't it? Isn't it for protection? Isn't that what it's all about? So who's ever heard of retirement plan protection or retirement plan insurance? Very few people, quite frankly. So what about the $50,000 IRA? What about the $200,000 in the 401k plan when you're over 59 and a half years old? What about that money? You know, most people I talk to at seminars, quite frankly, I say, what's your greatest asset on paper when you do a financial? Most people say it's your home. No, ladies and gentlemen, normally it's not. It's the money you have. It's the retirement money that's sitting around. You know, if you have your home paid for, I hope you do, but if you have your home paid for, why don't you just drop the insurance? Why wouldn't you do that? Because you want to protect it, don't you? You don't want to have to replace it. Can you imagine replacing $200,000 401k plan that you lose 40, 50% of it or more? Because that's what I'm really talking about here. You wouldn't think about not having insurance on your home, even if it is paid for. I'm talking to you about protecting perhaps your largest asset, your retirement money, what you have in your 401ks and your IRAs and your 403bs and so on. That's what we're talking about tonight. So, what I'd like to do here is just talk a little bit about this next board. And I won't spend as much time on this one because I'm trying to give you basically just a baseline, a benchmark from which to work with. We talked about the red line, the market. if you can see this, I hope you can, but the thing is here, you take a look at this blue line, and the only reason I've done this is just simply, I want you to know what you have to have in return on your money to keep up with inflation. This is 3% right here. I don't care if it's 3% inflation, 3% CD, it's anything that grows at 3%. So what this is showing us is that you have $100,000 down here, back here in 1998. By the time you get to 2015, you need $165,000 to buy, let's say that $100,000 home right here. You need $165,000 here to buy the same home, if that would make sense. Look, this is safe. There's no fees, there's no risk. It's not being managed. I'm just trying to give you a benchmark so that you can make some analysis of what's going on with the market versus what's going on with like a 3% CD. Now here's the thing. You know what CDs were paying back here in 1998? Anybody remember? About 7%. And like Larry said, they're paying nothing today, so let's just take 3.5%. That's an average on a CD for the last 17 years. That's what it amounts to. So the question is this, I think. You take a look at this, and the expert says that the market outperforms everything, don't they? Well, you take a look at this. If this is a CD, out of 17 years, the market outperformed the blue line 6 out of 17 years. It's barely, the market is barely ahead. At the end of 2015 was barely ahead of that blue line. And if we taken out the fees, it wouldn't be. So is that really true? The market outperforms everything? I really question that. Now here's my question to you. If I could take the guarantees here, the blue line, take a look at the guarantees and say, look, if there was something out there today that would give you a floor like this, give you a guarantee, protect you on the downside, and still give you upside potential when the market goes up, would you be interested in that third option that I mentioned about 45 minutes ago? Because that's what we're really talking about here. So, I'd like to just share that with you if I could. And I'm not a creative guy, so this is just, we're talking about red, blue, and green lines. Pretty simple. So, before we get into this, let me just mention one thing. Maybe this will give you the image visually of what we're talking about here. If you just follow my hands for a second, if this in fact is the market, this is the market money back in 1998, and this is your money right here. We know in 1998 the market went straight up, didn't it? So the market goes up. With the green line, your money goes up as well. The next year the market goes up again, doesn't it? Your money goes up. What happens that third year? The market goes backwards 45%. What does your money do? It stays where it's at. You don't lose a penny. The next year it goes down again, doesn't it? You stay where you're at. The market starts to go back up the fifth year, you go up. Now, if you kind of got that visual image of the concept and how it works, then you can come back to this green line and say, okay, I kind of get this. I think I see what's going on here. So, that first year, the market took the money, took the account up to $120,000. You were at 115. You didn't get everything that the market gave you if you were straight in the market that particular year. The next year, the market goes up again to 137. You're 125. But here's the key. Knowing what you know now about this green line, what would you say would be the 4 most important years out of that 17 if you were on that green line? What would you say are the most important years? When you didn't lose a penny. Sometimes 0 is a hero, isn't it? Is what it amounts to. Tell you what, when the market goes backwards like this, it's really hard for the market to catch back up again. They almost caught us right here, didn't they? But then the market decided to do this again, like it always does. Market goes back up, we're going back up again. Just got the numbers. It's basically on a September to September fiscal type year. Just got the numbers. These boards will be updated within the next 2 weeks. We're up quite a bit, even over where we were before. But if you take a look at the market is at 183 at the end of 2015. We're at about $215,000. Ladies and gentlemen, I didn't take any fees out of this. Should have maybe. But this right here, no fees, no risk, beats the market. Ladies and gentlemen, it's a third option that provides you returns, safety, and guarantees that nothing else out there that I know of can offer. The market right here did a 361. That's what that is, 361. This is 3 or about 3.2, something like that. That's a 361. We're somewhere at 4.3% right now as an average. We didn't have to make up for the losses. Knowing what you know now, if you went back to 1998 and the market was up after 2 years, was up to $136,000 or $137,000, and you were at 125, which would you take? Would you take the market, or would you take the green line, knowing what you know right now?
Green line.
My money, ladies and gentlemen, I don't have one penny on that red line right now. None, period. Everything that I have is right here. There's a good reason for it, as far as I'm concerned. My opinion, I think we're going to see something happen in the next, who knows, 30 days, 6 months, 2 years. I don't know. I guess the question is, do you want to prepare for it before it happens, or do you want to wait till after it happens? Because that's really what this is all about, I think. So, moving on. The question I think is that, so what the heck is it called? What are these plans called? And what it's called is, it's a fixed income annuity. I think you're on it's your page 5, right? Fixed index annuity. Now, I just got done saying, not too long ago, that annuities, the variable annuity is something I don't like. Ladies and gentlemen, there's good annuities, there's bad annuities. I'm just gonna, that's my opinion, but I think it's absolutely a fact. And it's just like cars. Was Volkswagen a good car a year ago when they pulled all the shenanigans? Well, it might have still been a good car, but it certainly had a bad reputation for a while. So there's good cars, there's bad cars. There's good politicians, well, I don't know if I'd say that. But you know what I'm saying. So there's good annuities and bad ones. But the thing is with these, what we're talking about, the fixed index annuity versus variable annuity, they'll never go backwards. That's one of the biggest differences, plus we don't have any fees. So 2 big differences right here. So the question always becomes, so is there a good or bad time to move money or to put money on the green line? Never. There's never a bad time. If the market's up, you go up. If the market goes down, you stay where you're at. If the market's flat, you stay where you're at. Just from what you see right here, and this is the reason we showed you these charts, is that is there ever a bad time? I don't know when it would be, quite frankly. So, I guess the question becomes that, so who offers these? The same strong A-rated, A-plus rated companies that you may have already with life insurance, your health insurance, car, home, those kinds of things. Same type of companies. I'm only going to work with A-rated companies, the strong companies. That's the only ones we'll work with. So here's what I hear a lot of times on your, I think it's on your page 5, is that, look, there's got to be a catch. You can't be that good. And I always tell people right up front, if I consider this our first appointment, first time getting to know you folks, I would tell you right now, there's 2 catches to this. Number 1 is time. You have to commit to somewhere between about a 7 to 10 year time frame. So there'd be a 7 to 10 year surrender schedule on these, and people say, well, 10 years, that's a pretty long time. Ladies and gentlemen, the reason I talk to you about this right here in that red line, when do they want you to sell? Never. 10 years is nothing. I'm talking about 7 to 10 years. So, and in that time frame, you can take out 10% of your money. 10% free withdrawal any year. Now, does anybody know what the safe withdrawal rate is on retirement money so you don't outlive your money? You know, it used to be 5 and 6%. Now it's between 3 and 4. I just read an article yesterday. Now they're talking 2.2. People are living longer and the returns are less. That's not a good combination, is what it amounts to. So time's the first catch. The second catch is that what we call a cap. That's the maximum CAP. That's the maximum interest you're going to get in 1 year. So the market goes up, you go up. But if the market goes up 15%, 16, 17%, you may not get all of that. In fact, you probably won't. I want to be fair with you. Most people I talk to, I'm saying, look, you're going to land somewhere probably between 3 and 6% rate of return over the long haul. 3 to 6%. I got a lady we just reviewed yesterday. She's doing 7.25% for the last 7 years. That's fabulous. Protected money at 7%. She just happened to hit things just right, is what it amounts to. But still, so you got a cap on there, and you got the time factor. Now, down at the bottom, Here's what you don't want. You do not want hidden fees. It's just that simple. You don't want long surrender periods. And you don't want a company that has no track record. Those are the three things you don't want. So it just makes sense. What you do want, basically, on the other side, would just be the opposite of that. You want to make sure that you have no fees. I don't believe in fees. I don't like fees. One of the reasons I don't like the variable annuities. But shorter surrender periods, which I always say 10 years or less. And there's some stuff out there at 15 and 20 years, which is ridiculous. And the other thing is you want a rated company, an A-rated company that's got a good track record. And I sometimes add a fourth thing on there too, if you're taking notes. You want somebody to work with that's about my height, kind of looks like me from Sioux City, just wanted to see if you're still awake. Okay, so anyway, let's go on to your page 6. And what I try to do is I try to give choices, is what it amounts to. So when you come in the office, I better understand your situation. I come back and say, look, there's a couple, 3 things that maybe you ought to consider. And so what I'm going to do is I'm going to walk you through that real quick right here. And there's 5 features on these plans that you need to be aware of. I've listed those at the top of your sheets there, your workbook. And the first one is time, then reasonable rate of return, fees, liquidity, and bonus. So if you want to write in there as we go through this, the first one is, for as far as the time goes, is 7 years. The rate of return on each one of these 3 products would all be the same, 3 to 6%. That's usually, 5-6%. You get a 7, that's doing pretty good. But there's no fees on any of these, none of them. I told you I don't believe in fees. And they all have a 10% free withdrawal liquidity feature. Now this first product, there is no bonus. So that's number 1. Number 2, it's a 10-year product. You want to mark it there for under time. The second one is a 10-year, 3 to 6%, no fees, 10% free withdrawal, and then has a 4% bonus. So, Christy, is it okay if you and Larry decided to do this, is it okay if we give you a 4% bonus? That's okay. All right, good.
More would be good.
Okay. And by the way, that's also a death benefit, full death benefit. So you put $100,000 in, it's worth $104,000. You can kill a car accident the next day. The beneficiary gets $104,000. That's hard to beat. So that's number 2. Now, third one, there's a third option that I get pretty excited about. It's a 10-year product, 3 to 6%, no fees, 10% free withdrawal, same situation. But at the end, here we go, Christy, you might like this better. 15%. 15%. Unbelievable. I don't know how long it's going to last, but it's at 15% right now. This is an A+ rated company, got a fabulous track record. 15% bonus on the money. So you put in $100,000, day one it's worth $115,000. It even gets better. Let's suppose that you had this product, your $100,000, day one's worth $115,000, right? And let's say that the market gave you, as an example, 4%. They will give you a 50% match. For those who have a 401k plan, you can relate to this. Let's just say on your 401k, you sometimes will get a 50% match. This plan will give you a 50% match of whatever you get out of the market. So if you got 4%, take 50%, you got 2% to add to it. You get 6% the first year, in this example, on top of the 115. So 6% on 115 is 6 and is that 7? About 7,000? $6,900, right? So about $7,000 if I can keep it simple. $115,000, you have almost $7,000 to it. You have $122,000 in that example. You're guaranteed the $15,000. I don't know what the market will do, but in that example, you made $122,000 day one, or excuse me, after the first year. Not bad. Now, I will tell you this, that's designed to work like a pension where it comes out as an income stream over time, just like a pension plan would. I mean, if it's qualified money, you haven't paid taxes on it, you're going to take it out as an income stream anyway. So that's not a drawback. I just want you to be aware of it. So I'm just trying to give you an example of what 3 options would be for you. So let's just talk real quick. I'll try to wrap this thing up. We're pretty much on schedule, but I might just try to answer maybe some questions you may have, maybe you don't. But I think the next thing on your workbook is the frequently asked questions. And the first one is, in almost all situations, it seems like, unless somebody has a lot of money in their checking account, they just want to write a check, that's fine. But we'll take all kinds of money, whether it's qualified, non-qualified, out of a checking account, mutual funds, IRAs, 401k fund, it doesn't make any difference, 403bs. They'll take any kind of money for that last plan with that 15% bonus. But one of the questions you might have is what's my broker going to say? Well, number one, probably going to say, look, I'd like to have safety, I'd like to have reasonable rates of return, and keep things simple. So if that's important to you, if those things are important to you, then I think you just share that, is what it amounts to. But here's the real thing. I think it gets down to the point where are you more concerned about loyalty to your family and your money or your broker? I mean, I think that's the bottom line. Are you going to do right what's best for you? Or are you worried about maintaining a relationship with somebody else and keeping your money at risk? So what happens if I die after I purchase the green plan? This is about as clean as it gets. You name a beneficiary, it's outside probate, it passes direct, no fees, no cost. It's very efficient as far as how quickly the money passes to the beneficiary. Usually within 2 weeks, 2.5 weeks, the beneficiary has the money. So that's about as easy as it gets. Can I move my existing 401k plan without paying taxes? It's called an in-service transfer or rollover. No problem with doing it, no cost, no fees. A lot of advantages in doing something like that. We can talk more about that in detail if you're in that situation. How does my agent make money? Direct deposit right into my checking account. Listen, the insurance companies pay me one time. That's it. I'm not getting the 1% fee over here. So that's what's going on here. Think of this as a realtor. Ray, if you're selling your house, who's going to pay the realtor? The seller, right? Well, the seller to me is the insurance company. It's not you on the other end as the buyer. You don't pay. $100,000 goes in. If it's a 15% bonus on your money, it's $115,000. There's nothing that comes off the top of your money. And there's no annual fees either. So how does it work? Well, you control your money, unlike what's going on with the market like we talked about here. You have 800 numbers, you have me, you have home office access. You control things every year as far as the strategies that you employ for your plan, things of that nature. I can talk to you more about that, but you have a lot more control there than you'd ever have being in the market. Our process is basically pretty well proven in about 15 to 20 minutes. You come into the office, look, I respect your time. I hope you respect mine. But you come into the office, within 15 to 20 minutes, I'm going to know if I can help you, period. That's all I'm here for, is to try to help if I can. The thing is that if we were to do business, it may take another 45 minutes to an hour to do the paperwork, make phone calls, things of that nature to get money moved, if that's what happens. So I always tell people that if you're serious about coming in, it may take an hour to an hour and a half, depending on phone calls and paperwork and things of that nature. I try to provide you choices. I already talked about that. If you were coming into the office, bring with you only what you want me to take a look at. If you've got an account over here with your brother-in-law or something and you know that it's going to stay there, there's no sense of me taking a look at it. But if you have an old 401k plan, an old IRA, money mutual funds that's been going backwards on you, things of that nature, and that's what you want to consider me looking at, bring it with you. Bring your statement with you. Or at least let me know where that money's at. And we can call the company or whatever the case would be. The response sheet there you have in front of you, please complete that if you would, down below the bottom 2/3 of that. Sue will be around right after I get done speaking when you're eating and talking about that. But I really think it comes down to this, ladies and gentlemen. I mean, I think the real question is that how much money do you want to keep safe? And I'll tell you, probably 75 to 80% of my time the last 3 or 4 years has been talking to people about keeping the money safe, and I'm glad I have. In many cases, it's worked out very well for people. But if you want what I do, that's great. You check yes on that box. You talk to Sue. We set up a time to get together. I know you're busy. We're busy. We're very blessed that way to keep busy most of the time. But we have carved out a couple, 3 days that we'd like to try to get together with you if you want to talk, so you don't have to let Sue know what would work there. I mean this sincerely when I say that I think your timing is good. I really think that the Feds could be bumping up interest rates in the next 6 to 8 weeks, maybe a little bit longer, but I almost guarantee you when that happens that the market's going to go the other direction. So if you have money in the market, I would think it's something that you want to take a look at as an option, at least for some of your money, to protect it. This is only because of time. I'm going to cut out a couple of things right now that I can talk to you about at the table. But I really do consider this our first appointment. You get a better chance to know me, decide if you like me, if you trust me, if you want to get together with me, those kinds of things, and that's fine. That's what this is for. I would welcome the opportunity to get together with you. I would hope that you would get that consideration, and I do thank you for being here tonight. I hope you enjoyed this. I know you're going to have a good meal. So Sue's going to come around. Enjoy your meal, enjoy your neighbors, and drive safe going home. And I would just suggest that you look out for that red yield sign, Bob, okay? All right, thanks a lot. Enjoy the meal.
If you're finished with your